Joining me now with more on equities and where we could be headed from here is Rebecca Walser. She's CEO of Walser Wealth Management. Rebecca, great to have you, especially in studio today.
I know, thank you so much. It just doesn't matter how many times I've heard it or seen it. I love the opening bell. It just sets up the tone. So yes, let's have a great day.
Yes, let's do it indeed. And to that end, what are you seeing in the markets right now?
You know, obviously, I'm much more focused on the macro right now, and I think that the world is, because then we saw that when Trump came out with policies on his Liberation Day, April the 2nd, obviously, since April the 2nd, we've had a lot of gyrations to the downside and then recovery to the downside recovery. And then obviously over the, last couple of days, in our trading day yesterday, NASDAQ almost up 2.5 yesterday, just under 2.5. As you said, the S&P 2%, even the Dow was up 1.8, and it's all because Trump basically came out last week at the tail end and said, well, maybe we'll raise the EU tariffs that will go into effect June 1st to 50%. Over the weekend, he got a call from, Ursula in charge of the EU and basically said, we're willing to come to the table and really talk. And so he came out and then said, okay, maybe we're going to pause that also until July. So just even the pause to give negotiation time, both China being paused till July and now Europe being paused till July, is really giving him this time to really have these discussions. And I think that he does this, if you read The Art of the Deal, he does these things to set the table, to kind of stack the deck to go into negotiations. So that's what's going to happen is we now have to get to negotiations. If you look at the Fed and how they're looking at it, we had Austin Goolsbee talk on at the end of last week and talk about they're really not going to be in a position of being able to cut rates until they have more clarity on how the tariffs are going to be actually implemented, and they're being paused right now. And then not only how that implementation is going to impact, is it going to raise inflation? Is it going to create stagflation? And then they'll be able to react. So we're all kind of in a waiting game for now.
Does that put downside pressure, Rebecca, on equities, knowing that the Fed could wait? And of course, traders do like lower interest rates. Companies and Americans can borrow money for cheaper in that scenario.
Well, I think you have a bigger thing going on with equity markets right now, and that really is the bond world and the financial liquidity ratios globally. So what's happening we have something called the supplementary reserve ratio, which is, I don't want to go too into the weeds here, but basically this is a part of the Basel III requirements that came out after the last crash of the banks in 2008, 2009, the too big to fail era. Really promulgated rules internationally for bank reserves that are just now getting to the implementation stage. They're supposed to go into effect July 1st. That has got to be dealt with because you had the commercial banks of America saying we can't keep lending if the supplementary reserve ratio goes into effect. And the commercial banks are literally our direct supply line to our money supply, the M2 growth of the country. So if the commercial lending seizes up, then you're going to continue to see bond market issues. If you look at what happened last week, on Tuesday, Japan had a 20-year bond auction, and on Wednesday, the U.S. had a 20-year bond auction, and they both went pretty badly. And what that means for the audience at home is it was over a 5% yield that had to be moved. In other words, the yield at the previous market auction was 4.6. This one was at over 5%. That's the differential that investors were demanding. And that is not only related to the tariff policy, but it's also related to this big, beautiful budget bill that's, a very large package that is going to extend the tax cuts and add more to the deficit. And so what we're starting to see is that investors are saying macroeconomically, we don't see the global growth. And so we are going to demand higher rates of return when we're buying government debt. And that is a problem because if the money supply is seizing up, then where are the institutionals going to be pouring into equities? And that's how equities come back in here. So what you're seeing is if we have a global slowdown internationally and it affects, global ability to move money, then equities will retract because you'll have liquidity calls, you'll have, maybe reverse carry trade with Japan, which is another issue that we had in August of last year. So all of these things are really tied into equities. People just don't understand. They think bonds are separated from equities, and that's just not true at all.
So I am curious, Rebecca, in terms of where we go from here, how long might this take to play out based on what we know from the art of the deal?
Yeah, I would think that really July is going to be a great tell for us. And I think it's going to be machinations back and forth until then. You might see deals get announced before July, but it's hard for me to believe that we're going to be able to work out the U.S.-China trade deficit problem in 90 days. So I think it's going to be iterative, and we're going to have multiple successions of this. But literally what we're looking for between now and July is any kind of deals being announced that would ensure that equities could continue to see, okay, we're going to continue to get what we need to get in terms of liquidity, in terms of financing, in terms of commercial credit, and all of those things are together.
I do want to highlight this afternoon we'll have the Fed minutes, and we discussed the Fed earlier. earlier, tomorrow we'll get a first revision on first quarter GDP. We did see it contract fractionally based on the initial read. What could that tell us, the first quarter GDP tomorrow?
I think it's going to tell us that exactly what we probably already know, what you just said, which is we have had contraction in this space. Do we have, I mean, the Trump administration wants to say the contraction is not because of them, because the tariff policy wasn't put into place yet. And that is true. The tariffs were not yet put into place, but they were announced. And once they were announced, you definitely have CEOs and boards meeting the next day saying, how are we going to change our supply chains if this really comes to fruition? And unfortunately, those conversations should have happened in 2020 with COVID, when we had supply chain issues getting stuff over from China to us with everything being shut down. That's when we probably should have had those conversations, but it didn't happen. And so now they're being forced into these conversations. And so it will be great tells to get, iterative deals being placed, but I just don't see us getting a final forever announcement. And I've even seen, like, if you look at CEOs, they're talking about tariff policy for 4 years. They're literally now kind of couching and framing it as only a 4-year thing and it will be over when Trump is gone. And I think that's a mistake too, because you certainly can't start to reroute supply chains and have that only be that's just not viable for 4 years. This is a long-term, long runway that requires a lot of infrastructure development. So to say tariffs for 4 years and to think of it that way, you might just brace yourself to deal with it for 4 years. But what company could really deal with something that is that economically, devastating for 4 years? It's not possible. So
yeah, Rebecca Walser, always good to get your take, especially in studio today. Rebecca is the CEO of Walser Wealth Management.
Thank you.